When you have the amount of margin debt that you have the complacency that you have the correlation between assets as high as they are right now, that just makes the market very fragile. And the range of returns right now run between about 8,000 on the S&P and about 5,500. So there's a lot of potential. And of course, that means that market could do anything in between those two ranges. So there's a lot of potential outcomes for next year, which means that, which leaves room for plenty of unexpected events, things that nobody's counting on.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the Ascendant portfolio manager, Lance Roberts. Lance, how you doing, buddy?
It is all intents and purposes. It is Friday, and I'm very happy for it this week. So, just glad to be getting this week over with. It's been
Good. Full transparency, you and I just talked about we need to make this one a little bit shorter than normal because we both have daughters that are coming home for the holidays, and we're both excited about that. So, well, look, I picked Ascendant because a lot of things have been rising. And we'll talk in just a minute about kind of the news, the Fed drop that really pleased the markets. As of yesterday, so we recorded this on Fridays, as of close yesterday, S&P and the Dow closed at all-time highs. A number of other assets are in that same territory, especially silver. Now the markets are selling off a little bit in the morning we're talking about here, so who knows where things are going to end up at the end of today. But Lance, we do seem to be in a state where the tide is rising, and this is largely tied to, or at least past couple days. And I know, Lance, you always say we're always looking for the narrative, and it doesn't necessarily match what's actually driving the markets. But the Fed came out this week and it cut as everybody was expecting the Fed to do. But what the Fed did surprise the markets with was that it's going to start basically buying $40 billion or so worth of T-bills a month. So to make sure that, quote, there are ample enough reserves in the system. I think the market heard QE, huh? Is that what you said? And said, this is great. The Fed put his back. And so markets did quite well, and a lot of assets that benefit from Fed, we'll call it printing. Like the precious metals reacted very strongly as well. Bitcoin, started showing some life again. So anyways, why don't we start here? What were your key takeaways from what the Fed announced this week?
So let's start with what the Fed said, and because they actually made a couple of interesting statements on Friday. And by the way, I'm covering this in a lot more detail in this weekend's newsletter as well. So you go by realinvestmentadvice.com and click on the Bull Bear Report. I'm going into a little bit more detail. But so first thing they said is to your point, they're going to start buying $40 billion worth of bonds. How long that's going to last, who knows? It may be a month, it may be 2 months, maybe 3 months. It's not really a permanent fixture. But the Fed does not classify that as quantitative easing. They classify quantitative easing as the purchase of long duration bills, where they're purchasing, and actually purchasing is the wrong word, they're swapping 10-year durations for bank reserves, right? So the Fed does not print money at all. They do not influence the monetary supply. What they do is they swap reserves for banks. They basically credit the reserve account. It's a digital transaction. They take the asset, the 10-year treasury in that case for quantitative easing, and swap reserves. So that's all that happens. It's an even swap of assets. What they classify as reserve management is when they're buying bills on the short end to make sure there's plenty of reserves in the system. So that's what they're doing now, is to make sure they're providing ample reserves for the banks to operate and function. Of course, we've talked about recently the repo stress, et cetera.
Mm-hmm.
I thought the more interesting thing that they discussed was really about the economics. They came out and said basically that the BLS report of employment is wrong. It's basically overstating jobs by about 40,000 on the upside. What the Fed said is that they're seeing job growth at a negative 20,000. So that's about 60,000 job difference between what the BLS is saying and what the Fed's saying. Yes, sir?
That caught my attention too.
Yeah. Now, take that piece of news and then you overlay that with their economic projections, which was they saw an uptick in economic growth going into next year. a downtick in inflation and a downtick and an uptick in the unemployment rate. Why that's interesting is that's really talking about this whole data center AI build out, right? We're going to increase activity and productivity in the economy, which is going to come at the expense of jobs and incomes. And of course, that also leads to lower cost goods. That's deflationary in nature. So that brings the cost of goods and services down. So their actual outlook for economic projections was interesting because it's really not that great for the economy. It's great for stocks because that suggests that earnings will remain elevated, but it may not be so good if you've got a job and want to keep
Can
it.
I just mention one thing? Because I heard all that and then reacted similarly to you, although I did hear one different thing than you, and I was just checking it while you were talking. So he talked about the unemployment rate softening, or the jobs market softening, and they expect unemployment to rise to 4.5% by end of this year, but then down to 4.4% by the end of next year and 4.2% in 2027 and 2028. So I didn't take a like, oh, we're sacrificing jobs for this. I took it as the Fed saying, hey, we've got some of these worries and we think the BLS is overstating the health of the jobs market and everything, but we still think everything's going to be sunshine and roses.
Well, they always think everything's sunshine and roses, right? The outlook's past this next year. Who knows? Who knows what's going to happen with AI and data centers and all that in 2027, 2028. But I think what is material for 2026 is seeing this uptick in the unemployment rate. At the same time, you're seeing slower economic activity. In terms of inflationary pressures, those type of things. That doesn't again that jives well for corporate earnings, but I don't think it jives so well for economic prosperity.
Yeah. Well, so we'll see. Now, I think this is going to be a really interesting year. I think this is the year where everybody's really got to figure out what side of the table they're on in terms of how they're going to place their bets. Um, Inflation, the Fed talked about how, hey, look, services have been disinflating. We're seeing goods inflation, but we're still trying to figure out if that's like a one-off price increase from tariffs or if tariffs are going to create a sustained inflationary pressure from here, right? So the Fed is basically saying, we don't know yet. We're in wait and see. The I would say, a number of the analysts that I talk to here are concerned about sort of, persistence higher than desired inflation. So the sticky inflation, some are worried about stagflation, right? But then on the other side, are there people who are saying, hey, look, the economy, it looks like it could slow down, but also like you, I think we've talked about this a lot, Lance, just mathematically, if you look at the inputs to CPI, and again, folks, I'm talking about inflation as measured by CPI, the official measurement, 40% of that's from shelter. And we've been looking at the real-time data for a good long while now this year saying, hey, that is showing disinflation or in some cases even deflation. And that data that we were looking at is now catching up to the very lagged data sets that get input to the CPI for shelter. So, it almost doesn't matter what happens with everything else. Shelter alone is probably going to pull CPI down materially as we go into 2026. So you're sort of nodding as I'm saying this, but
No, that's right. No, that's
you
just a
think that way
function.
too, right? Yeah.
And also take a look at what oil prices are doing. Oil prices are a massive input into the overall economy. And what's happening with oil prices is also disinflationary. So there's a very, very high correlation between the CPI readings and oil prices. And with oil prices looking like they're going to slip into the high 30s, low 40s over the next year or so, that's also going to be additional disinflationary pressure to the economy. And that was one thing also that Jerome Powell noted correctly was that, while tariffs are certainly a impact to inflationary pressures, either on the producer side or the consumer side, it's a one-time impact. And, that's important to understand is that if, that thermos that you're drinking out of, you paid $10 for it and they slap a tariff of 10 cents on it. So now it's $11 and it's $11 next year because of that tariff. There's no inflation. And that's the one thing that it's important for investors to get their heads around is that you've got to separate out what's going on at the grocery store with what and how the markets operate. And this is again, when you and I talk about inflation and interest rates and economics and those type of things, I'm talking about it from the market perspective. How does that impact the markets and us making money? What happens with too many individuals is they go, yeah, but you haven't been to the store lately, and I saw egg prices going up. Yeah, that's fine. And maybe you don't agree with the CPI number. Maybe it's very subject to where you live as well. You may not agree with the employment numbers because of whatever your personal situation is, but set all that aside because all that matters is what the market's paying attention to. So again, we're not making commentary based on our views on what we think inflation are doing or anything else. We're talking about how is the market interpreting it and how does that impact your portfolio? Because that's why we're here talking is about how to make more money in the markets.
Yeah. Okay. So to my point, you kind of have to start to really place your bets next year, right? Are we going to have persistent inflation or are we going to have disinflation, right? The other one is really going to be on the GDP side, right? So, whole host of reasons to be concerned about slower economic growth next year. You and I talk about several of them, every time we get together at the end of the week here. But then you have others who are saying, well, hey, look, first off, let's just look at GDP. It's actually grown pretty decently here in 2025. And going into 2026, we have potentially corporate America really starting to benefit from AI, right? So we might go from the academic to the practical part of actually seeing benefits from AI in the corporate world. And the administration would say, and everybody, you're going to start getting, tailwinds from what we've been setting in place for 2025, right? All our deregulation and pulling foreign capital into the US and tariff revenue and, all that stuff. So I understand that people can feel passionately about whichever way they think this can go. And I know people who think passionately on opposite ends of the spectrum here. So this is one of those years where you're really going to have to kind of place your bets going into it, I think.
Yeah, no, and you do. And that's why I'm saying from an investment perspective, which is all that matters to me, is that pay attention to what the data is saying. Because again, the data is what's going to drive markets ultimately. And again, you can disagree with inflation or employment, but if the market agrees with it, that's what the markets are going to do. Right. So you're kind of if you're trying to fight the market, it just you make the whole investment job harder on yourself.
And right now, I guess because the markets, at least as of yesterday, was at an all-time high, market's feeling pretty sanguine so far about next year.
Well, and markets are off. As we're talking this morning, markets are down about 1.25% or so in the S&P, coming off an all-time high, and we're just in a big trading range right now. And this, you and I talked about this before a couple of weeks ago. We started talking about, hey, first 2 weeks of December, just expect a bunch of sloppy trading back and forth because mutual funds are distributing gains and all that type of stuff. So this kind of action we're seeing in the market is, we're coming up with all kinds of reasons. Oh, the market's down today because of Broadcom's earnings last night. No, we're just in that distribution season. And again, we just want to try to apply a rationale for why markets are doing things. But we're probably going to slop around here for another week or so going into Christmas. And then everybody's going to go on vacation starting late next week. Inmates are going to run the asylum. And then that's when you get kind of your year-end rally when these managers start kind of building their books for year-end reporting. So seasonality wise, we're playing right along course of kind of normal market trends right now.
Okay. All right. Well, look, you know, you've got to place your bets for next year. And I know you're a portfolio manager, Lance. So obviously you don't just plan for one outcome. You plan for probabilities of different outcomes, right? And diversification plays a real big role in helping shelter against you being wrong if your primary thesis is wrong. Um,
Which is
uh,
why we made some trades this week specifically for that reason, just
Great.
to start providing some hedges for that.
And we'll get to those trades. But what's interesting is, I know you've got some concerns about next year. You've raised them, particularly around earnings, right? Particularly around earnings in the small cap space, which I think are still projected to increase by what, like 40 or 50%?
59% right now.
Oh my God, that's just
You
crazy.
got this is the irony of it, right? So if you take a look at S&P 500 earnings, like 50% of the earnings are driven by 10 stocks. So the other 490 stocks are divide the other 50% of earnings is coming from 490 stocks. Pretty incredible. But you look at the Russell 2000, you've got 40% of the Russell 2000 that has negative earnings. So when you're talking about 60% earnings growth in the Russell small cap space, which it could happen. I'm not saying it can't happen. It just seems like a very lofty, kind of very lofty expectation, considering that over the last 3 years, there was virtually no earnings growth coming out of the Russell
Right,
2000. So
right.
you're talking about a real resurgence of economic activity next year to support that, because small caps and mid caps are their profits and earnings are heavily tied to economic activity. So unless you're going to get 4% economic growth next year, which nobody's really expecting right now, I'm not sure how you're going to reach those kind of more lofty expectations. Doesn't mean they're not going to make money. I'm not saying that at all. It just seems like 60% is an awful big number.
Okay, so let me just make sure I understand this. So they're expecting 59 or 60% earnings growth from the Russell from
Right.
this one.
And
Okay, but 40% of that index has no earnings or negative
right.
earnings. So is that basically then like expecting like, I don't know, 150% earnings growth from the ones
Yeah.
that are positive?
When you start doing the math, right, that's where it starts getting really difficult to wrap your head around. But here's a good example. I just posted this chart this morning. Let me share this with you real quick. So this is a chart of earnings growth. No, this isn't. This is a chart of earnings growth over the last 5 years. And, so 2022, we had slower economic growth. 2023, 2024, you had really good earnings, really good economic growth in 23, 24, really. And, except for the first quarter of this year, it's actually been decent. I mean, we're talking about right now, I think the Atlanta Fed's saying 3.6 or 3.7% growth for Q4 right now. But in these years where you had really good economic growth, 31% and 41% of earnings in the S&P 500 came from the Mag 7. The other 490 barely created any earnings. But see, this is where I'm having trouble with this. The economy's slowing down. So in the years that we had really strong economic growth, the bottom 490 couldn't generate really any earnings growth. But now somehow we're expecting that in 2026 we're going to have this expansion of earnings growth, even though the economy's slowing down. And I'm not saying, look, please understand, I'm not saying that it can happen or that it won't happen. I'm just looking at this going, how is this going to happen if you're expecting higher unemployment, slower economic growth, declining inflation, because inflation is part of earnings growth. It seems like you're kind of fighting headwinds here at the same time that you're expecting the Mag 7, you're expecting their earnings to basically be flat next year from where they are here, right? We did 21% growth this year, expect 23% next year. You know, they're not going to be driving the earnings growth like they did previously. So when you're talking about $330 to $340 a share in earnings by the end of next year, it seems like you're really setting yourself up for some disappointment, particularly when valuations are like forward valuations are near 25 times earnings. You're just really starting to put a lid on what markets can generate.
Okay, so it's not the first time I've heard you mention, that series of concerns there. And I know you're not calling for a bad year next year, but I know that you're also not calling for a gangbuster year next year. And I know that we've talked about just statistically, the odds of another strong double-digit year of returns in the markets is low, just because we've already had three back-to-back years like that, which is rare in and of itself, right? Um, that all that said, uh, given that you had those concerns coming into this week, the fact that the Fed just announced it's going to be injecting liquidity into the system, does that make you a little bit less concerned because the Fed is kind of riding the rescue here, or no?
I would. It's not that 40 billion is 40 billion is not that big of a number considering the size of the market.
Yeah,
I
but
mean,
but half a trillion in a year is not nothing.
it's not going for a year. It's just going to be for a couple of months until as soon as they get liquidity, the kind of liquidity run sorted out, maybe a month or two or three from now, then they'll probably tether that off. Now, again, don't forget that they've stopped QT. So part of this bond buying is simply the roll off of maintaining their balance sheet. So if I have, and this is going to be the one thing you'll see some headlines like
Yeah.
this coming up in the next couple of
Yeah,
months.
and sorry, and I'm curious to answer this in your answer. Is that really true, or is this 40 billion on top of what they would have already been doing to keep the
Well,
balance sheet fixed?
they didn't clarify that, right? They just said they're going to buy 40 billion.
Yeah.
So they didn't clarify this as anticipation, but they got a couple of things going on. Is that first of all, they're letting mortgage-backed securities roll off entirely. So they're trying to get out of the mortgage-backed security market.
Right.
So you're probably going to see some headlines coming out, people going, "See, I told you the Fed's doing QE. They did 130 billion in purchases last month." Well, that was because they were doing 40 billion plus they had another 60 billion in mortgage-backed securities roll off. I'm just picking numbers, right? It could be
Yep.
anything. But they had, 20 billion in treasuries mature, 40 billion in, mortgage-backed securities mature, and they've got to buy those. So as they buy those, they're going to buy shorter end bills for right now to provide liquidity to the markets. But they could very quietly be also adding to long duration bonds in the background. So as short duration bonds roll off, and I'm not saying they're going to do this, so I'm not making any statements. I'm just saying this is the one thing to kind of watch the composition of their balance sheet over the course of the next year as these shorter bills roll off of their books. They could start buying longer duration T bonds to replace the mortgage-backed securities that are maturing. So we need to watch the duration makeup of their balance sheet as we kind of go forward to next year, and that's going to give you a little bit more clues about liquidity and support and those type of things.
Yeah, and don't forget, and look, no guarantees how folks are going to react, but don't forget too that Powell is starting this, and he's going to hand the baton pretty soon to a new Fed chair who may be happy to take this even further, right? So your assumption that it may end in a couple of months, it's not really up to Powell anymore. It's going to be up to the
Oh,
new Fed chair.
it's really not. I just don't want people to run out and go, "I'm going to start taking on a bunch of risks because the Fed's doing QE," because this really isn't QE, so to speak. And it's really not. It is different than what QE is. It's certainly supportive of markets. I'm not going to deny that because when the Fed does an asset swap, and this is where the term printing money comes from, even though they're not printing money, they create reserves in the banks. And then I had a lot of people go, "Well, just because they create a reserve for the bank, how does that wind up into the financial markets?" Well, what the banks do with reserves is they loan those out, but I have a couple of ways to loan those out. I can loan some money out to Adam over here to go buy a house for 30 years at 4%, or I can loan that same amount of money to Citadel Securities or to hedge funds or whatever at a higher interest rate, and it's a much shorter duration on the loan because those are going to mature on a regular basis as loans get as that leverage moves in and out. So there's a lot of money that winds up in the financial system through increases through leverage, balance sheets. Basically, anybody that can tap the repo window that can wind up into the financial markets, money market accounts, pension funds, kind of you name it.
Yeah. So a couple questions on that. So as we talked about last week, just because the Fed extends reserves doesn't mean the banks actually lend based on that, but they usually do. And that's
But they
sort of
don't
how it,
lend to you and me on that.
pardon me?
They don't necessarily lend to you and me on that.
Right. But to how you just described, that is how sort of the asset swap for giving the banks increased reserves lets them then lend out more money, and then more money gets in the economy. So that's sort of how the printing money happens here. So Lance, you've explained here why this isn't technically QE, but the markets seem to have heard that,
Yeah.
right? And pardon me?
Yeah, markets want to hear what they want to hear. So yeah, markets love look. There were three very, very dovish things that came out of that statement. So this is what the market liked. One, the market liked the fact QE, not QE. Again, this is going to be a topic of huge debate over the course of the next couple of months. There'll be tons of articles on it, both sides. But that's one. Um, so markets like that, more liquidity, good for the markets. They like the fact of higher unemployment because that means more rate cuts,
More cuts, yeah.
right? And then they like the fact that the Fed basically talked about a downtick in inflation heading towards target this year, et cetera, because that's also supportive for additional rate cuts and kind of easier monetary policy. Because again, a slowdown in the economy, what the Fed wants to navigate is a slowdown in the economy. They don't want a recession, but they want to navigate that return to price stability. So all that was very accommodative for and again, it was a much more dovish statement by the Fed and speech by Jerome Powell, much more dovish than the markets were expecting.
Yeah, this to me is just it's a quick little rant, but it's like the it's almost like the doctors are cheering a patient who's getting sicker, right? Hey, we want this patient to get sick. We don't want him to die, right? But he's losing blood. That's a good thing because they're going to give him more steroids or adrenaline or whatever, right? So we don't want him to lose all his blood. But yeah, we're super happy that he's bleeding out here, right? I mean, it's a weird thing that the market wants to see signs of weakness.
But what about all the people buying gold and buying silver and cheering and rooting for dollar debasement, loss of reserve currency, crash in the markets? I mean, you've got people paraded on your show talking about these very things, and you're rooting for the worst possible economic environment. Why? That's not healthy for anybody. And it may be great that you own these assets, but if you don't convert them into wealth at some point, it didn't do you any good. And that's my whole point when I'm on the show with you is look, we got to maintain a balanced view about all this stuff because you're right. I mean, it's weird that everybody's rooting for the worst things to happen only because right now it's beneficial for their assets. But again, most people aren't going to sell their assets and profit on this stuff. And when the reversal occurs and things really do get bad, all this stuff is going to tank all at the same time. In fact, this weekend's article in the newsletter is talking about the Bank of International Settlements just came out with an article called the double bubble. And very, very interesting perspective about what happens when the downturn really occurs. It's not going to leave a lot of stability for pretty much anybody.
Yeah, so I'm just going to correct one thing you said because I think you're going to get a bunch of comments on it. I don't think the majority of people, at least who watch this channel, who own precious metals, are buying them because they're rooting for the end of the world. I think they're worried about where the system could go, and what they're trying to do is purchase insurance, something that will keep at least part of their purchasing power in place for where it is
Well,
right now, which I know you see as your goal as the portfolio advisor is to protect purchasing power.
well, yeah, exactly. But if I was going to preserve purchasing power, I wouldn't buy gold. I'd buy stocks. Far outperforms gold over time in
I
terms
know
of.
you would, but some other people aren't.
Well, no, I understand that. The reason that people buy gold, and again, look, I get all the emails from your listeners, right? It's like, oh, Adam had this guy on, said the dollar's getting debased, or the reserve currency status is going to get lost, and so I'm buying gold because of this. I get all those emails from you, and it's, again, you just posted an article talking about, and I'll talk to you about this after we get off the air, talking about metals, for next year, which is great, no problem about that. But the problem is you're rooting for the worst possible outcomes because it's beneficial to your asset price right now. Let me ask you this question. If gold was tanking right now and going down 30 or 40%, would you be buying gold on this idea that the economy was going to slow down or improve or whatever your thesis is? At the end of the day, we're all buying an asset because it's going up in price. When it goes down in price, we don't want it.
Yeah,
And
which we
so
should if we believe in the thesis.
right, right.
Westerners are very bad about that, but yeah.
Exactly. And most people's theses fall apart eventually at one point or the other. And then they wind up on the other side. And this is why people lose money over time in the markets. It's just a function of it. But this is my whole point is we need to set all that stuff aside and understand why we're investing. What do we need to invest in to achieve that goal? And if my goal is to preserve purchasing power parity, I want to buy stocks. Over the long term, it wins every time. But it's okay. And again, there's nothing wrong. Like we have a portfolio, it's long gold and silver. It's doing
Yeah.
fantastic, doing
And
great.
look, and I'm not disagreeing with you saying either. You put up the charts in the past about over the long stretches of history, stocks
Yeah,
have beaten inflation better than any other asset. Yeah.
exactly. But that's the whole point is that so when somebody says, oh, I'm buying gold because I want to protect against my purchasing power, okay, you're buying the wrong asset. It's an okay asset to own. I'm not saying you shouldn't own it. It has outperformed inflation by a small margin over long periods. Now, I'm talking about 50, 60 years. By a small margin, it does that. Stocks have done much better. So are you really doing yourself a favor? Or is your thesis based on some other narrative, which is why you're buying gold? See, that's what I'm saying. You just need to separate those two things out. If my goal is to preserve purchasing power, I want to buy the very best asset for that, right? If I'm going to go race a Formula F1 series race, I don't want to take a Volkswagen to that race because I'm probably going to lose, right?
Yeah.
I want to
So I get the point you're making here, and I think the audience is too. All I'll say is you don't have to be all in on either. You don't have to be all in anything. I know you agree with that. And again, just to put on the precious metals holder hat for a moment, you might say, yeah, I agree with Lance that over the long run, stocks have done a really good job staying ahead of inflation. But I've got valuation concerns right now. Buffett ratio highest it's ever been, CAPE ratios through the roof. So I don't want to be all in stocks if I think that they could go through a really big correction. So maybe I'll own both.
Right. But here's the problem. Now you own two assets. This is the Bank of International Settlements view. You own two assets that are now highly correlated. So basically, you've got two assets in the same race, and that which
Potentially, and I agree that correlations of almost anything, everything have gone to one lately.
exactly, and that's the Bank of International Settlements view is that the only other times in history that this has occurred, the outcomes have not been good for the holders of either class.
Yeah. All right, then. So then what should we be holding here?
That's going to be the challenge. No, this is going to be the huge challenge. And look, I'm not saying that the markets are going to correct next year by any stretch of the imagination, but if you take a look at from current valuations in the markets, forward returns over the next 5 years are going to be close to zero. Now, it doesn't mean every year, right? I
Right.
mean,
And I've heard some say 10 years.
no, yeah, I'm just saying, but 5 years and 10 years will be close to zero. They're very close to each other.
Yep.
But that means that somewhere in there you're going to have a negative 20% down year somewhere in there. And then the markets are going to rally back and you get back to zero. So that's going to be the challenge. It's going to be the timing and where you invested during that declination. Because if all assets are highly correlated, small caps, mid caps, gold, silver, stocks, Bitcoin, they're all have a very high correlation. So when all the money is going in those assets, when it reverses, it's going to come out of all those assets at the same time, which means that maybe, as we saw in 2022 is a really good example of this. Go look at 2022. What asset class protected you the best in 2022?
I mean, I want to say gold. I can't remember, but gold was pretty flat.
Gold was down.
Not
Stocks,
much. Not much. Not certainly not compared to stocks or bonds.
cash was your best performing asset in 2022.
Okay.
So because it protected your purse power. Everything else was pretty much negative. I mean, you lost value in pretty much everything in 2022. So the point is that you want to be in an asset class, and again, knowing where that asset class is, I don't know, right?
Yeah, and let me just flag this because I'm totally in concurrence with you. This was the big focus of the interview I did with Jim Carson, a week ago. His big thing is volatility, and he would say, "Hey, hold some volatility here as insurance for this period that you're talking about." But he basically said, "Look, what you got to look for are non-correlated assets, or really, yeah, uncorrelated assets."
Right.
And he's got a bunch. I can't really name them off the top of my head, but there are. Presumably they're out there. It sounds like you're saying, Lance, more than normal. This is a year to look for non-correlation.
Yeah, and look, and there's been some great non-correlated staples have performed terribly this year, right? Bonds have really gone up or down. They've just been flat most of the year. They've been trading a big range. So there's some assets that are non-correlated to the market that may provide a safe haven in a rotation. And again, but again, the problem is that rotation may occur in 2026, could be 2027, could be 2028, and that's the problem you don't know. And so if I say this is as I've said to you before, is that the problem with people saying, "Oh, the markets are going to crash, so you better be out of stocks because markets are going to crash." Well, yeah, they're going to have a major mean reversion someday. Someday we're going to be down 30, 40, 50%, almost guaranteed. Problem is it could be 5 years from now or 3 years from now. And so between now and then, the markets could be up another 100% before you get a 50% correction and you wind up right back where you are today.
Right, right.
That's the
Let
problem.
let me ask you a couple quick questions here, just about some particular sectors. Um, I don't think it's uncorrelated, but you and I have talked about oil and gas, and you guys have created a thematic portfolio there, and your simplivisor about that. Um, could that be one where maybe the reason correlation's lower because it's done poorly while the markets have done great over the past couple of years. But it may have sort of like a secular tailwind behind it as you go through these boom bust cycles, right? Which it might be able to power through some of the uncertainty of a generally declining market.
Well, it depends. So you have to say why is the market declining? And we don't know this answer, right?
Right.
If it's a financial credit crisis that's affecting the overall economy, then oil prices are probably going to drop pretty sharply because they're linked to the economy, right?
Yep.
If it's a if it's just a revaluation of the market based on a realization that earnings are not going to keep pace with kind of forward valuations right now where they are. So it's just basically a valuation adjustment. So that in that kind of environment, money's going to start looking for things that are undervalued. And
Right.
if oil prices we think oil prices can probably get closer to 40 before we're finished with this kind of declination, sometime next year, maybe year after. But at that point, yes, if it's just a mean valuation reversion in the markets because of, it's AI doesn't mature like everybody thinks it does, capex is slows down dramatically, whatever. If money starts to rotate towards value, yeah, I think staples and energy and real estate and utilities will probably do very well because those are typically kind of defensive risk off rotation sectors because they have higher yields. So people
Yep.
start looking for safety of capital and yield in that environment.
Yeah. Okay. So obviously, this is part of your work there with Michael at RIA is to say, okay, where do we think this capital could rotate into if markets start softening? How about an industry like cannabis? And I mention that only because it's all of a sudden in the headlines as of like the past 24 hours, where it sounds like the administration is, I can't remember the exact news, but they're basically looking to ease regulations on the cannabis industry. So an industry like that where the catalyst really isn't economic, it's more regulatory, right?
Yeah. So interesting you bring that up because again, I've just had this announcement, this administration starting to be more favorable towards potential cannabis. 4 years ago, no, I'm sorry, 5 years ago, I went to Canada and went to the World Money Outlooks Conference. I was the keynote speaker 5 years ago. And at that conference, every small cap, they had just one manager after the other coming up to give presentations. Every one of them was saying, you need to be long cannabis stocks because this is going to be the next great trade. These things are going to the moon, et cetera. Here's a
Right.
chart of Steel Ray going back, about 3 years. Uh,
Yeah, I know. I know
so
they just got destroyed.
yeah, and here's the bump today, right? See this little green thing down here? That's the bump on this announcement today. So
Right.
so my and again, that's just Tilray. It's just a good example. My
Right.
point.
So, real quick, I think one of the reasons why they did so poorly, I mean, I think they found logistically this was a lot harder than they all thought it was, and the state tax revenues didn't materialize the way they thought. But I think a big part of the assumptions was that cannabis, and forgive me, I don't know much about this industry. It's a Schedule One drug. I could be wrong on that designation, but basically, it's on the federal level, it's still designated, I think, with the same in the same category as illegal drugs like cocaine and stuff like that. And the expectation was that the Biden administration was coming in, was going to be very cannabis favorable, and was going to take it off that list. And therefore, all of a sudden, it was going to be so much more easy to transact in the space. Because I think right now, if you're a
That was
cannabis company, you can't bank because your revenues are being made off of this Category One or Schedule One drug.
by the way, that's one of the storylines of Tulsa King. If you watch that on Paramount Plus with Sylvester Stallone, great series. I highly recommend it.
Really, I've only watched season one. Does it get better after that?
Oh, yeah, wait, how far are you into season one? Have you finished the season?
I think I finished season one.
Has I don't want to spoil it for you. Has he gotten in bed with the marijuana producer yet?
Oh gosh, I know he got in bed with a woman, but I think she worked for the feds. So
He does. She works for the feds, but yeah. So yeah,
okay, so
you're
maybe I didn't get to the end of it.
okay. So when you get to this point, what I'm about to say makes sense, right?
All
But
right,
5 years ago, this was also the expectation. The expectation was is that the government was going to remove the category class on it, that
right,
it was going
and,
to
and
become
that's what I'm saying. That's why they were so high back then, and then it never materialized. Yeah,
tons of expectations, and then nothing ever came from it because there's a lot of because remember, it's not just the federal government. There was a lot of pushback from the states. Texas is a very conservative state. They're like, no, we're not going to legalize cannabis in Texas. Colorado did, and the results have been kind of a mixed bag.
right.
Revenues,
California did, and all the smaller operators that have been in the state forever all got crushed.
yeah.
Yeah.
So anyway, there's a lot of headwinds just because the government makes this announcement. You know, there's a lot of headwinds to actually getting that done. You still got to get this passed through Congress, through Senate, everything else. So it's this has been a battle that's been going on for 5, 6 years now, and eventually, I mean, I can't imagine that it's someday it doesn't get legalized. I think there's becoming, particularly as the older generation dies off and the younger generation comes up, they're much more lenient in their outlook about this stuff. So I think eventually, at some point, it's going to become a legalized, over-the-counter kind of medication.
I think it probably will. And look, for the record, folks, I don't like cannabis. I wish it didn't exist,
You're
but
saying it.
and no judgment for those that enjoy it. But I was just on Twitter. There was a chart that was just sent around showing that alcohol consumption has dropped to its lowest level in the United States since I think Prohibition, right? And a lot of that is just like, hey, the younger generations aren't really into it. But I asked, and so oh, interesting. But then I asked, okay, so is that just, they're just more health conscious or teetotaling, or are they swapping their consumption of what do you want to call these things? Chemical substances. And it turns out it's much more the latter. So if you include things like marijuana in there, then substance usage is actually higher than it's been overall. So yeah.
No, I agree. And so basically, you're saying you're no fun at parties, but
Oh,
um,
did anybody have any doubts about that by this point?
yeah, you look at like Constellation Brands as a good example. STZ, they're a big alcohol producer. That stock has been crushed. That stock was almost over $300 a share in 2024. It's down to about half of that now. It's just had a huge smashing over the last year. But that's just Constellation. But you look at a lot of those kind of alcohol providers, wine, spirits, those type of things. Those stocks have all been under tremendous pressure because of consumers really, they are starting to pull back on drinking. What I think will be interesting is if you could get, you know, uh, marijuana legalized, to see companies like Altria, Philip Morris, et cetera, your traditional tobacco producers moving into that space would be almost automatic. So again, I think you wind up with the same problem is that, if this does get legalized, smaller producers are going to get acquired or run out of business.
Yeah. So I'm not an expert in this, but in California, my understanding is that's exactly, it's already happened there, which is a lot of the kind of acreage in California, at least, has been bought up by these companies. Maybe they're just sitting on it until it fully gets legalized. I don't know. Maybe they've got operations there. I don't really know the details here. All I know is that um, there used to be a ton of small operators in California, especially up in Northern California where I used to live. They all got decimated because of both that, but also too because cartels. You had all these Latin and South American cartels that were operating up in the national wilderness there and creating tons of product and undercutting the profitability of the small folks there. It's really kind of an incredible case study. But the reason why I brought all this up, Lance, was again not to be super pro cannabis per se, but to say in a world where you want to look for non-correlation, do you want to look for industries like cannabis, which can have its fortunes changed not by what's happening in the economy, but by presidential edict, if you will, or like biotech, right? Where like, hey, if you all of a sudden come up with a drug that helps with cancer, it doesn't matter what the economy is doing, your company is going to do great.
Yeah, I think you have to be, but I agree with that statement. But again, you've also got to think about risk in this.
Absolutely.
So for instance, here let's just I'll just show you a couple of different charts here real quick because this is your thesis is very valid. But here's a chart of Biogen. This is a monthly chart. This goes, wait, this is 2015 back over here. Um, biotech can make you a lot of money if they're hitting everything right, every time. But there's a tremendous amount of risk revolving around FDA approvals, those type of things. Biogen hasn't made you money in 15 or sorry, 10 years. It's actually been a money loser. But you can spin that off and go to the granddad of Biogen, which is Amgen. It's been great. So it's going to be, part of investing is not only having the right thesis, but also making the right stock selection within that thesis. So, and again, you can see the same thing. Remember, yeah, here's Moderna. Remember the producer of the COVID drug?
Right. But
You-
that's my point exactly, right?
Yeah,
Which is no,
that's
the first half of that. It did amazing
yeah,
because of regulatory slash non-market, reasons, right? I mean, at that point, we were shutting the global economy down,
that's right.
right? But Moderna did fantastic.
They did.
Yeah,
And here's Pfizer, right?
yeah.
Great during COVID, has been absolutely crushed after that. So my point is the point that you're making, and you're absolutely correct, is that as investors, we want to be looking for these non-corollary assets. So when the market breaks, the market's going to search for valuations, it's going to search for dividend yield, those type of things. Pfizer might actually be a very, as opposed to Moderna, which only basically has kind of one drug in the
It's a
pipeline.
one-trick pony. Yeah,
Pfizer has a lot of drugs. The problem with Pfizer is that a lot of their historical drugs are coming off of their patent, so they're becoming over the counter. Like, if you've noticed lately, like every TikTok channel, every YouTube channel, every commercial on television, every other one is for like Blue Chew or some form or variation of Viagra.
some Viagra, yeah, derivative. Yeah, we're going to talk, I think about this in the rant with concierge medicine. But yeah, literally, my doctor the other day was like, "You're in your mid-50s. Do you need any of this?" And
No, I'm
well,
fine.
thankfully, I don't think so yet. But he was like, "Because it's only $1 a pill," and I was like, "Are you kidding me? Is it that cheap?"
Yeah, it is. And that's one thing that's weighed on Pfizer, right? That's impacted their earnings. If you take a look at their earnings growth, so this is their sales and earnings growth at the bottom. The big problem with Pfizer is they can't grow sales because of that very problem, right? They're getting their product pipeline is getting eaten up by competitors now at this point. Now, we take a look at Eli Lilly as a countermeasure to that. Eli Lilly, of course, just announced yesterday they have an osteoarthritic drug that just did very, very well in trials. But of course, this is also the maker of semaglutides, which are your weight loss drugs. And so this stock has been doing fantastic. But again, you compare that with say like a Novo Nordisk, which is doing okay. What is the? Sorry, I forgot the symbol for Novo Nordisk. There it is, India. This is their direct competitor to Eli Lilly. So I bought Novo Nordisk makes a weight loss drug just like Eli Lilly does, but Eli Lilly's eating their lunch in the market. So again, it's not just making sure that you get the rotation right. So when you're looking for a valuation change, if I'm going to buy cannabis stocks and I'm going to buy biotech stocks because I think that's where money's going to go to. That thesis may be very correct, but you could have a very bifurcated market within that sector. So you also have to make sure your asset selection, your company selection is right just as much as getting the rotation right.
Yeah. So I think this series of charts has done a great job of reinforcing what we talk about a lot, Lance, and a lot of other experts that have come on the channel have come in to say as well, which is, the passive playbook has worked really well, but we are highly likely entering into an environment that's not going to be as kind. You just talked about the potential lost half decade or lost decade that lies ahead of us, in terms of the market really kind of maybe not going anywhere, in the next 5 or 10 years, although of course it'll be probably very volatile. So if you're just sitting there passively, yeah, you're probably not going to make much at all, lose out to inflation actually. But if you have a good active approach and you capture your objective of trying to capture 80% of the upside, but only 20% of the downside, you can actually do quite well. But you can't just buy the market, and you can't even necessarily just buy the sector index. You're going to have to really look to do the old-fashioned gumshoe detective work of finding the wheat amidst all the chaff.
Oh, you mean you'll actually have to do some research? That's just not just buy stuff because it's going up. Yeah, that's
Yeah.
gonna, that's going to be the interesting thing. And this is, but again, we've transformed the markets. I mean, we've taught a whole generation that to buy stocks, you just go into Robinhood and start poking numbers.
And you
And
always buy in the dip and you lever up and.
yeah, it's pretty amazing. I did a chart, some analysis earlier this week talking about margin debt.
I was just about to ask you about that. Yeah.
Okay. Well, no, so Simon White, who I greatly respect, he writes for Bloomberg. He
Bloomberg.
did,
Yeah, I've interviewed him on this channel a couple of times.
yeah, great guy. He wrote a great article, but he was looking at margin debt, interest expense as a percentage of GDP. And I was like, okay, well, that's fine. And it's very elevated, by the way. Margin interest debt expense, how much you're spending on your margin debt that you have. That's at a very high level right now compared to GDP. I said, but yeah, but when you're looking at GDP, that's encompassing all the aspects of GDP, government spending and exports and imports and business spending. I said, is there a better way to look at this where, as me as an investor, how much am I paying in interest expense? So I compared that to real DPI. And when you look at that chart, the amount of money that's being spent on interest expense to carry margin is at the highest level ever on record. And it only has these spiky peaks prior to big market corrections. So again, it's not saying the markets are going to correct and crash tomorrow, but it's just these anomalies that you get in the markets when you have all this speculation hype. Everybody's chasing every asset class higher. And look, you know, regardless of the asset class you're in, whether it's gold or silver or stocks or biotech, whatever, a lot of these things are doing fantastic, and you should be long these assets. Just realize that this ride's going to end, and as is always the point I'm trying to make is just don't forget to take profits. Right?
Yep.
It's great that silver's going up like gangbusters right now. Just don't forget to take some profits, because and this is the big debate that Mike and I are having, and because of our all weather portfolio. We launched the thematic version of that all weather portfolio in August. So in 5 months, it's running a 25% annualized rate of return. And it's abnormal. That portfolio should not be running a 25% annualized rate of return in 5 months.
Yeah.
It's,
Yeah.
that's just not, it should be that way. Um, but everything in there is doing great. So that portfolio has dividend yielding stocks, high quality dividend yielding stocks. It has gold, silver, uranium, platinum, a bunch of other precious metals in it, and it's got fixed income. And everything's doing great all at the same time. And that shouldn't be the case. That portfolio should have diversification in it, where some assets underperforming and other assets is outperforming, and it's not. And that's the concern right now with the market, is that everything is doing well all at the same time, and those periods never end well.
Yeah, yeah, no, that's
This
that
is
correlation that we were talking about, plus a bubble factor in there. And I just want to note, just in real time, when we got on, Lance,
yeah.
um, silver futures this morning hit $65 an ounce. Just crazy. Um, they're now down to 61.42. So they have dropped almost 5% in the hour that we've been chatting here.
I posted a really interesting chart this morning about silver. Let me see if I can find it real fast, because again, this is the conversation Mike and I were having yesterday. We're approaching year end right now. So part of the trades that we'll talk about in a few minutes is we did some tax loss harvesting, and did some swaps in the portfolio. But part of that conversation is revolving around, again, kind of what we're talking about here. But this was a chart I posted out this morning on X. This is the number of times. Let me make this bigger. This is the number of times that silver has reached all-time highs each year going back to 1975. All-time highs for silver are a very rare event.
Yeah, but that's because the inflation adjusted high back in the 80s was so gargantuan.
Right. Well, but even so, just the price, just nominal price. So this is just nominal price of silver. The issue with silver is that when it spikes, it has massive corrections afterwards. And so you're looking at potentially a reversal at some point, not today, not tomorrow, not next week. But if you take a look at this kind of left shoulder right here, very similar to what you saw in the 06-08 period, the decline, and you had this massive spike higher, and then you had the correction. So a similar outcome of this is going to put silver back in $25 to $30. And so that's my whole point. Don't forget to take profits, because silver has a very bad habit of reversing most of its gains on inflation or nominal basis, even log scale or not log scale. You're going to wind up with a very similar type of outcome at some point, because it's a speculative asset. It's there's no fundamentals, there's no dividend yield, there's no anything, right? It's just buyers and sellers moving price. So again, it's great, and this is the conversation Mike and I are having. Just don't forget to take some profits along the way, because it will eventually reverse.
Yeah, I agree with that wisdom. And let me just chime in here as a long-term silver holder and talk to the people that are saying right now, Lance, it's different this time. Um,
What they said
it,
before.
it may be different this time. I mean, there are supply issues that are driving a lot of the shortages right now. But you know, markets react, right? And all I can say is we may be going through a repricing of silver. I actually kind of believe that we are. I am not going to sell my physical ounces here, but I definitely will hedge on the paper side. And as somebody who has owned silver for a long time, I have lived through two of those periods where silver really ran up and then went down, basically gave up the majority of its gains and was dead money for a long period of time. Is that going to happen from here? I don't know. But to Lance's point, I know that it can happen. And therefore, I think if you are riding the silver wave and loving it, I'm right there with Lance, which is don't do it without a net. Have some sort of plan in case silver does repeat the pattern that Lance just showed there. Could it be different this time? And it doesn't. Maybe it only cools off by 20% rather than 50 plus or whatever. Who knows? We'll find out together. But I just want to Lance's point, I just want to say, don't get high on the, on the euphoria right now. And it's kind of funny too, because I'll oftentimes see people who will be so critical of people who have ridden these hyperscaler stocks, up on these parabolic curves and have said those people are crazy and yet are doing the same thing. They're just naked long, on the precious metals here, right?
Well, and again, it's just good portfolio management. And look, if you go to our website, allinvestmentadvice.com, click on the resources tab, we have a whole series of ebooks. And one of those ebooks is on investing rules and how to manage your portfolio, some guidelines around that. Again, nobody's saying sell everything and go to cash. And this is whenever you talk about things being overextended, overbought, those type of things, immediately everybody says, oh, it's wrong, it's different this time, and for these reasons. That's the rationalization, right? That's how we rationalize higher prices, is by saying it's different this time. Things change. And like Adam said, if there's a supply shortage, somebody's going to wind up needing supply at some point. Either there's going to be a point to where people holding silver wind up selling it, and that creates a supply on the market, or producers ramp up mining and bring supply to market. I'm probably going to get Mike needs to rewrite his article. He wrote an article probably 6, 7, 8, 9 years ago about the Hunt brothers trying to corner the silver market.
Yep.
And the market met the demand, right? They did very well with it for a little while, and then everybody started scraping the back off Polaroid film, selling their mom's silverware, you name it. Supply will show up, and that's the thing that gets the market. So again, the whole point is just as we're managing our portfolios, it doesn't mean sell everything. It means if you have 10% of your money in silver or gold, both, and it's now 15% of your net worth, trim it back to 10. Take that money, put it into cash. That way, if it does pull back, you've got some cash to go buy it back at a cheaper price, right? That's the whole point of managing money over time. And that's how
Yeah. And folks have heard us talk about this a lot, so we won't keep banging the drum. But again, folks, this is why I think for a lot of people, just outsourcing all this to a professional who can do this on a regular basis for you, so that you can just focus on making more money and let them do all the gardening and the clockwork and the tending and all that stuff. It's a great compliment. All right, Lance, let's get to your, well, if you can, pull up the S&P. Let's just do the technicals real quick. Then let's get to your trades.
Oh, my face is all bright right now. I'm getting the glare from the
from the chart screen. Okay,
exactly.
but yeah, let's do that. Let's do your trades, and then let's try to get the rant in here before we have to leave. Just because we've had a lot of people that were interested in our tease last week of the rant on concierge medicine.
Oh, okay, because I totally forgot what the rant was going to be on. Okay, great, we'll do that. So here's the market. We're right now running in a very nice upward trend. Markets are down today a little bit, still on a buy signal. We're not grossly extended in terms of relative strength. So again, the market's just kind of trading here. And what's interesting is that despite all of the rhetoric, again, you've had all these people very concerned about the sell-off that we had in October, November. It's like, oh my gosh, the AI trade's dead. all we've been doing is just trading in a very big trading range, really just consolidating this run up from the April low. So we had this massive run. This was the sharpest post drawdown recovery since the pandemic. So you were down 20%, recovered it all, and just kept on going. So this is all actually very bullish for the markets in general. And this kind of consolidation action we've got going on right now is kind of what we said. Expect in the first 2 weeks of December, this kind of, back and forth, kind of sideways chop action that we've got going on. And then that'll set you up potentially for a rally in the year end. And we're probably going to wind up this year about where we are, give or take. I mean, we're up about 17% for the year as of yesterday. So we're up 16% as of today. We'll probably end up 17, 18% for the year. Slap on your dividend to 1.9%, 1.8%, and you're at a 20% total return year. And that's kind
My
of what
goodness.
it's shaping up to be right now.
Yeah, that is, it is what it is. And this is why I always say, don't fight the market. You know, be practical and trade the market you have. But I think it would have been challenging at the start of this year for folks to say, oh yeah, we're going to have another 20% up year for the market for the third year in a row.
I was right there. Remember, wrote the article talking about curb your enthusiasm. I said more volatility, lower returns. Well, we definitely had more volatility,
Yep.
but returns were way better than I thought we were going to have an 8 to 10% year this year. Um, and here we are at near 20. Now, going into next year, I'm already writing a couple of articles for next year. In the next week or so, I'll have one out looking at current valuations, and every year we produce a range of outcomes based on valuations. So we say, okay, valuations are here, and if we have a slowdown, recession, kind of margin neutral status. In other words, we don't really increase a valuation kind of neutral status or valuation expansion status. What does that mean for returns? So I'll have that article out, and the range of returns right now run between about 8,000 on the S&P and about 5,500. So there's a lot of potential, and of course that means that market could do anything in between those two ranges. So there's a lot of potential outcomes for next year, which means that which leaves room for plenty of unexpected events, things that nobody's counting on. Everybody's very complacent right now that everything's going to be kind of the same next year as it was this year. But that's the type of environment where unexpected events occur and you have, unexpected outcomes. And I think that's really going to be the theme for next year, is just watching for an unexpected outcome of something.
Okay. Well, that'll be interesting then. So folks, that'll be our job, obviously, with these weekly meetings between Lance and I, is to just keep our eye on what's happening in real time in the market. And if and as unexpected developments occur, we'll deconstruct them in real time to determine what we think, what impact they could have on the markets going forward from here. But Lance, I don't want to put words in your mouth, but do you feel, again, after 3 blockbuster years in the markets and with valuations as stretched as they are, is the market kind of on a knife's edge here, in the sense that just an unexpected wind from any direction could push it over?
Well, it's certainly more fragile, right? When you have the amount of margin debt that you have the complacency that you have the correlation between assets as high as they are right now, that just makes the market very fragile. So remember, why do markets go up, right? It's all because of a thesis, and everybody's betting on their thesis to be right. So I think that gold's going up for this reason. I think stocks are going up for this reason. I think that Bitcoin's going to go up for this reason. Those are the rationales that we put behind our narratives. So that's why we're betting our money. I mean, we don't go to Vegas to bet on a hand of blackjack and go, yeah, I think I'm going to get a pair of twos and I'm going to bet heavy on it, right? It's just,
Unless you're Austin Powers, right? Great scene in Austin Powers.
exactly right. So we're betting on our thesis to be right, and when you have everybody kind of betting on the same thesis, that makes the market more subject to fragility, because any disappointment will have a magnified effect on the outcome. A good example is just look at Broadcom earnings today, right? Broadcom killed it on earnings. Their earnings were fantastic. Stocks down 13% today because
and Oracle, similar deal, right?
Oracle's earnings were great, just not quite perfection. And that causes the big markdown. So again, if we get an outlook next year that all of a sudden maybe earnings aren't going to be $330 a share, they're only going to be $280 a share, all of a sudden valuations at 25 times earnings are now 30. So now we've got to readjust. We got to reprice the market for lower expected earnings. That's what makes the markets across all markets very vulnerable because once capital starts to flee, um, things get very difficult quickly because those exits to get out of the markets are very, very small right now.
Hmm. God, who was I talking to? I don't think it was you. Uh, Maybe it was Jim. Uh, but it was because of the leverage factor that it was like not only is the theater
That's me.
it was you jammed, but now everybody's obese, and
Yeah,
so you're
yeah,
trying to yeah.
you got all these obese people in the theater trying to get out the doors.
Yeah. So exit door is still the same size, but the people trying to get out of it are now a lot bigger. Yeah.
Exactly. Yeah,
Okay. All right. Well, look, can you walk us through the trades? Because it sounds like you've made some interesting trades.
yeah. That was a politically incorrect version of the exit strategy, by the way. Um,
That's all right.
so this week we did some tax loss selling. So we're getting into the year. We had a couple of positions that have not performed. We've most of the portfolio has done fantastic this year, but we own a diversified portfolio, so staples have been underperforming this year. So we had a very small loss in Procter and Gamble. We took that off, replaced that with Verizon and Altria. And so the reason that we made that swap is that we're kind of building a little bit of hedge for next year into the portfolio. So first of all, Verizon and Altria have very big dividends. They pay 7% and 8% respectively. So big dividend yields for these companies, but we're building some small positions into the portfolios right now. So if we get a risk off rotation, rotation is likely to gravitate towards companies that have bigger dividend yields, kind of a more fundamental factor to them, trading a little bit cheaper than the rest of the markets. Same thing in the equity growth, the dividend equity growth model. We swapped out Kimberly Clark for American Electrical Power, which was a utility company. Again, bigger dividend yield, good technical chart on it right now. So we're just kind of making some adjustments within the portfolios to add a little bit of a defensive sector going into next year. And if we do see that rotation to staples and defense, then that'll provide that hedge against a rotation out of the growth factor. We've had we talked about this in our daily market commentary over the last week, is that you've had a significant outperformance of growth over value over the last 5 years in particular, really kind of a more unprecedented level. You're eventually going to get a reversal of that growth value trade. And so you want to have a little bit of value. That may not be next year, it could be year after that. But I think having some defense in your portfolio is going to wind up paying off for you.
Okay.
And
Next couple of years.
plus I get paid to wait. If I'm making 7% and 8% on a holding, I don't need it to do much.
Right. 7, 8%. That you're saying that's the dividend yield or that's the income you're getting.
Yeah, yeah. So I don't need it to. I don't need the stock to do much. I just need it not to go down a lot.
Right. But if we have the revenge of value and capital rotates out of growth into value, you could maybe get the best of both worlds, right? You can get the
Absolutely.
tasty dividends plus capital price appreciation.
Correct. Absolutely. And this is a point I was making earlier this week is that people get too tied up in chasing market returns and they really forget about why they're investing capital and investing capital to, and as you said earlier, right? The reason we invest capital is to outperform inflation over time. If that, we as investors, we need to really kind of step back and, we get all excited about markets. Markets up 20% this year. I need to make 20%. But if we really step back and just go, hey, I need to make 6% a year, 7% a year to reach my goal, there's a lot of companies right now paying 4% dividends, 3 and 4% dividends. Bonds are paying 4%. I don't have to do a whole lot of work to automatically have 4% built in my portfolio every year. And that means I need 2% appreciation. That's not hard to generate out of a portfolio. So we just need to get a little bit more realistic perspective about what we're doing.
Okay. All right. Well, look, very well said, Lance. Another great week. Um, I think next year is going to be, I'm going to make the prediction now. I think it's going to be a very interesting year that's going to keep us on our toes in these
Yeah.
weekly discussions. And I kind of look forward to that, to be honest, a little bit.
Yeah. This year's
Um,
been boring, actually.
Pardon me?
This year's been kind of boring. So,
Well, it was pretty interesting in April, but then it got boring after that. Yeah.
yeah.
Okay. So, in the
Rant.
time left, I'm going to push some topics to next week, but I do want to end on the rant as I said. So we gave a quick little nod last week to the fact that both you and I have joined concierge medical practices. You've done it for many more years than I. I just started it, and yes, folks, to a certain extent, this is a little bit of a um, hey, this is a, these are two guys who have enough money to be talking about this. But I got to say, like the cost of the concierge services are really not that much, at least in my case. I pay for the year, I pay about what I pay for a single month of my health insurance. So it's for not a lot of extra cost. I get to go to a doctor who has a small practice of patients, so he can get to know you. When I go in and talk to him, I spend an hour with him. He's not shooing me out of the office. He wants me to stick around, and we talk about pickleball and other stuff, right? So it's like the opposite of what happened to me when I went into Kaiser, where they were like, "Okay, you've been in here for 7 minutes, get out," right? Um, he learns all about my situation. I can call him or text him at any time, and he gets right back to me. It's returning a bit of the old school, you know, the doctor with the bedside manner. This guy doesn't necessarily make house calls. I haven't asked him if he does or not. I'm sure there would be an additional fee with that. But it's great to get that care and just have a doctor who just sort of, fully looks at everything that's going on in your life, because generally what happens now is we go in, we get treated for some symptom, and then they turf us out, and they're on to the next patient. This is somebody who can really be looking at your entire health data set and saying, okay, what larger picture is this telling me about your general health situation, and what are things that I can tell you as your doctor to kind of get you from wherever you are to a better level, or at least keep you at the level that you're at, right? So one of the things he did with me early on was just to say, okay, Adam, look, you're a new client, you're a male in your 50s. Let's talk about all the things that could kill you, right? And let's go to the ones that have the highest probability, right? That's heart disease, that's cancer, right? Let's do a whole bunch of different screenings for you on this. So I think I mentioned last time I did a CT scan of my heart to look at all my arteries there, got the results back. Fortunately, they were negative, no plaque at all. So he's like, great, let's just try to focus on keeping you plaque free from here. But now we don't need to worry nearly as much that certain behaviors you have might trigger a heart attack, because you're in pretty darn good shape there. I was waiting when we were talking last time, Lance, for the results of my cancer screening. By the way, that CT test exam cost me $125. So for the knowledge and the subsequent peace of mind I got, absolutely worth paying for. The cancer screening was a little bit more expensive. I think it was more like $700. But it screens you for something like 20 to 30 different types of cancers. And the intent of the test, it's not perfect, meaning they can't test for every single cancer out there, and it's better at detecting some cancers than others. But the intent there is to say, well, let's do the best we can to try to catch as many cancers as we can early on if you have them. And if so, let's get you treated while hopefully it's in early stage 1 versus finding it out later on when it's at a more advanced stage. Got that back. Happy to say no markers for cancer. So that was wonderful. Again, just the peace of mind benefit of that alone is great. So there's several other tests like that we're going through right now, which are basically just like, the basic diagnostics. And then once we have the baselines, then the conversation shifts to, okay, great. How do we protect the baseline, or how do we raise it, right? So again, I'm in the midst of that, but so far, very happy with it. As I talk an awful lot about, and I'm sure we'll talk about my broken tooth in a bit here, Lance, but like, I try to keep reminding people on this channel that money is important, but it is not a form of primary wealth. It is a means to wealth. What is real wealth? It's quality relationships, it's having meaning and purpose in your life, and it's having good health. And I think everybody sort of generally knows that when I say it, but you don't really appreciate it until all of a sudden you lose one of those things, right? And having just had this sort of, in the big picture scheme, relatively minor issue of having to have an emergency tooth extraction, I was just reminded there in the moment, in that pretty gnarly 3-hour procedure of like, man, this sucks. And I'm going to have I'm going to be dealing with this for at least half a year. uh, anything that we can do to preserve our good health or, increase the quality of our health is way more, we're going to get way more life returns out of it than just what happens with, the numbers in our portfolio, given what the stock market does over any given period. So anyways, I can't recommend this enough for people that are willing to look into it. How has your personal experience been with your concierge service?
Well, for me, I talked about this on the show is that, it's great, right? So every year I get blood tests done and the doctor looks at all my blood tests. We screen and he screens for all these different things. And then he balances all of my hormones
That's a
basically.
great point. Sorry, I forgot to mention that. They did that with me too, where it's like, okay, here are the things you're deficient in. So, hey, go get supplements in these or change your diet to get more of this stuff, right? It's really useful.
Yeah, it is. And so, as we get older, right, testosterone levels fall, that has impacts on your body. Serotonin, you have all these different kind of levels that are in your body. So for me, because I work out all the time, my goal is to maintain strength. And as I'm getting older now, because I'm 60 and progressing fairly quickly through my old age, maintaining strength in the gym, maintaining muscle mass, those type of things is important. So, he looks at all these different kind of markers and then provides me a good regimen to keep that, I'm not trying to get, massive. I just want to maintain what I've got. So he makes sure that all my hormonal structures are in balance to do that. So that's all fine and dandy. But like I said, where I really found the value was when my wife went to her gynecologist and said, and he did the ultrasound. She's having some pain in her abdomen, and he's like, "Oh, you've got he did the ultrasound. It's like, I think there's some tumors there. I'll let me send off a test and I'll get it back in 2 weeks and we'll figure out what they are." I'm like, 2 weeks? That's ridiculous. I picked up the phone and called my doctor, and he's like, "Have her at the doctor, have her here tomorrow at this location." Had the blood test done the next day, had the results the day after that, found out that, she had, potential cancer. And then, ever since then, he's been following her every step of the way as we go through this cancer treatment. He's, there on duty. Pretty much if we've got any questions, we call him. He makes adjustments. He works with our cancer doctor. And that's where the real value was, right? The real value is, it's not just the maintenance. It's when you need a doctor and you go to call your doctor, like, "Oh yeah, we can get you in a couple of 3 weeks, 4 weeks." I called the doctor, before this. I called the doctor once. I said, "Hey, I just want to come and get a physical checkup. 6 weeks, I'll get you in." Right.
Mhm.
That was kind of the marker point where I said, "No, I'm going to go get my own doctor." Because when you want a doctor, when you need advice, you want something right now. And particularly when it's a loved one, it's like, I don't want to wait. I want to know right now what's going on. What do I need to do? And that's the real benefit of having a doctor, quote unquote, on call.
That's great. So I think I've mentioned this many times. I'm from a family of doctors, and they say, look, our healthcare system is the best in the world, but that doesn't mean that it's perfect. And you really have to be your advocate in the system. And especially if you're going in to get treated for something and it's not really working, there's kind of like a progression that they go through. And every time you go in, they go to the next step in the progression, right? So he's like, you got to just keep going back and arguing so that you can hopefully get down to whatever step it is that finally addresses what you have, right? But if you're not pushing, the system's not going to be pulling you through that process. And a lot of people just they're not experienced with that, they're not good at it, whatever. It's just frustrating that you've got to be there, the constant squeaky wheel to keep going back. And a lot of times, Lance, you're like, okay, yeah, we can see you again. So your point, come in 6 months, 6 weeks or whatever, right? So to have like a professional advocate for you there who's got contacts and knows these people oftentimes personally and can just say, hey, look, drop what you're doing, get my patient in there tomorrow. I'm concerned about X. It can be really valuable, or in the case of your wife, possibly invaluable.
Well, and that's the whole point. I was going to say this is that, you know, you may be thinking to yourself right now, is like, wow, this sounds really expensive. I'm not sure I can really afford it. That's the way I felt about it initially. I was like, man, this is kind of expensive. But I will tell you at the moment where I needed that doctor and I called Dr. Bain and I said, "Dr. Bain, here's my problem with my wife." He says, this is what we need to do. Let me tell you, it's going to be costly to get it done quickly. It's going to cost a good bit of money to do this. And I was like, I don't care. I'll go take out a loan from the bank. I
Yeah.
don't care because this is my wife. She is my world. It doesn't matter what it costs. I will figure out the money later. And that's where again, that's when you don't have access to that, when you need it, it doesn't matter how much money you have or don't have. When you need it, that's where its value is.
Yeah, and again, folks, this is why I talk about why money is a means to an end. Like this is why we work to build money. Yes, we want to build a prosperous future for us, but we also want to have the reserves that when we're in a point of need or someone we love are in a point of need, you exchange the money for the solution you want, right? But to my point is, in general, this isn't that expensive. Now, when you get into a place where the guy is doing something extraordinary for you because you have extraordinary circumstances, yes, the bill goes up, but if you have the means, you're happy to pay it because it means you're getting something acute treated quickly.
Well, no, this is the whole thing with insurance, right? There's a lot of complaints about insurance and all these type of things. And hey, I get it, right? Healthcare costs have gone up. But we've done a lot of that to ourselves. The Affordable Care Act was, when you inserted a third party into the insurance system, it was going to drive prices higher. But there are doctors that you can go to that I interviewed a doctor. He has a practice out in Kansas, and he has a menu. And you go in and like if you need, you know, appendectomy, whatever it is, there's a cash price for it. And that cash price is substantially lower than if you go through insurance. And so, one of the things that we can do to advocate for ourselves better is save up some money, have a cushion set aside in the bank for medical issues. Um, Make sure if your company offers you an HSA, which is a health savings account, that you fully fund that every
Yeah.
year. And like my wife, I don't have one through my business, through my company, but my wife does. We fully fund that, but we never touch it because it grows tax free. Your withdrawals are tax free. Your contributions are after tax, so it's tax. Basically, all your money's taxed. It's a triple tax benefit for an HSA. We'll probably actually never use that for medical reasons. I keep another pot of money over for deductibles, but that's just a great benefit. If you have available one, I certainly encourage you to do it. But the reason that you do that is use a high deductible plan where maybe your deductible is $5,000, but your premiums are going to be a whole lot lower. And since you don't get sick if you take good care of yourself, if you exercise and you eat right and you do the things you should be doing, you may not use your insurance very often, but if you're paying for the $20 copay every time you get the sniffles, that's costing you a lot in terms of your healthcare premium. So think about moving to a high deductible plan, save up some money on the side to meet that deductible, lower your insurance cost, and then when you actually need the doctor, then you use that money you've saved up for that pot of money. So you can save some money on insurance that way and lower your costs by using a high deductible plan. Be responsible for your own quote unquote maintenance, and then shift some of that money to like Adam's saying, and seek out white glove medical care. And there's a lot of companies now that are now offering that service. If you could probably search like white glove concierge healthcare services near me on Google and probably find quite a few doctors close to you that offer that service at a fairly reasonable price.
Yeah, and I know an increasing number of doctors that are going concierge, um, kind of for their quality of life, right? I mean, they hate the way that the current system works just as much as the patients do, and they've their dream getting in was to have a good doctor-patient relationship and to try to be able to give people the full attention they needed and all that stuff. And the way the modern system sort of metastasized, they just became these, over-programmed order takers who were on a stopwatch. All right, get that patient in, get them out, right? So they're actually trying to help create this new solution space too. And so to your point, Lance, I think if you Google, you'll probably find some people around you, and I'm going to bet over the next couple of years, the supply of them is only going to increase.
It also makes a lot of sense, right? So if you're a doctor on the traditional system, in order to make money, I've got to see patients all day long, right? Get them in, get them out, kind of on a conveyor belt. But again, how often do you use your medical service? This is the same idea as owning a gym. So back in my early youth, I used to build big 15,000 square foot, you know, fitness facilities.
Right. And then hope people would sign up for it and then never use it.
But that's the whole game, right? I could oversell the memberships because people never come back. They and this is why you can't pay cash to go in or write a check to go into a gym. You have to put it on a credit card because they'll just keep billing you.
Right.
And then your excuse is when you get the bill, you go, well, I'm gonna go to the gym next month. I'm gonna get back on my diet next week. But this is a beautiful model for doctors if they will adopt it, because again, people don't go to the doctor every day. But if I can get people on a monthly payment, right, or an annual payment or a semi-annual payment, I can sell a lot more customers, have that annuitized revenue stream coming into my business, and then I just have to manage my flow of when people actually need me. So it's actually a much more profitable system for doctors than the current system. But and that's why I agree with you. I think over the next few years, we're going to see a large majority of doctors starting to at least offer this service because it's a good model.
Yeah. Well, I also got a lot of emails and comments from folks since last week, Lance, with their own stories of going international. And it's something I can't speak to from experience, but it just makes sense that obviously lots of other countries don't have the bureaucracy we have here. I've known people, who live abroad, countries like Thailand or whatnot, where they're like, "Oh yeah, it's like a cafeteria menu." I mean, you just go in and say, "I want that, I want that, I want that," and it's a cash price, and it's what you're getting right when you go in, and the prices are ridiculously small fractions of what it would cost you here in the States. Now, you as a patient have to determine your level of risk tolerance of what would happen if you had a botched procedure in a country like this, and there's that risk. But it just makes sense over time. A lot of doctors in these countries are coming to the U.S. to get educated. They learn our Western way of doing it, and then they go back to their home countries and practice there. And then, of course, they train other providers in their home country. And so over time, it makes sense that the quality of healthcare in a lot of these countries is getting better. And so, you might want to look at, they call it medical tourism. I don't know if that's really a great way to refer to it, but there may be a number of procedures where maybe you may want to jump a border and get it done for cheaper elsewhere.
Yeah. Well, again, but you have to factor in airfare and hotels and all that.
You
So
do. I mean, but that's how inexpensive some of these things are. The people are like, you can go, get your procedure and have a wonderful vacation and come back, after 2 weeks with a tan, and still have it be a lot cheaper than what it would have been here, and maybe even get it faster, right? So again, I can't speak firsthand about all that stuff, but it's
absolutely.
obviously another option to look into. All right. The other thing I wanted to talk about real quickly on the health part is I did a 5-day fast recently. We talked about it on this channel. I've just had a couple of people say, "Hey, can you just tell me a little bit more about that?" And I'll tell you some real quick things. And Lance, I don't know if you've fasted or not, but you can chime in any way you like on this. Um, so real quick, the human body is actually meant to fast, and this just makes sense. Back in caveman days, you didn't bring down an elk every day, right? There were long stretches of time, especially in the winter, where food wasn't super plentiful, and your body had to go into sort of a self-preservation mode until you got the next influx of calories. So the body is actually designed to kind of go through this self-preservation fasted state. And we don't do that in modern day, at least in most Western countries, just because food, fortunately, is so plentiful. So we don't give our body the chance to kind of recharge the way that the fasting process is designed to do that. So anyways, that's why fasting, if done correctly, is beneficial. Now, to be super clear about the fast that I did, it was a 5-day fast. I'm using a program called Prolon, which is very scientifically based. It is what's called a fast mimicking diet. So first off, it wasn't that I didn't eat anything for 5 days. You actually get food on every day, but it is low amounts of food. Think like thin soups and stuff like that. Um, and then some supplements and stuff to kind of help your metabolism. So what they want to do is they want to get you as quickly as they can into ketosis, which you should be in by the end of day 2. Once you get into ketosis, the hunger pains really pretty much go away. So by day 3, you're in ketosis. That's where your metabolic pathway is now burning fat for fuel versus burning glycogen or sugars. So once you're in ketosis, then what they're trying to do is kickstart what's called autophagy, which is when your body is not bringing in sufficient food. Um, your metabolic processes still need to run and they need fuel for that. So what the body does is it starts looking for damaged or old cells and it starts breaking them down into their base components to then use uh, to power your metabolism. And so think of it as sort of like a spring cleaning for your body, where it's getting rid of the senescent and the injured cells and hopefully eventually replacing them with better cells. So they try to keep you in autophagy for 3 days. And by the end of that, that's the end of day 5. Then you're done with the fast and you're supposed to sort of, ease your way back into eating regular solid food again. So anyways, I find it, I do it about once a year. I probably should do a little bit more often than that, but I actually find it really beneficial health-wise. Obviously, you lose a lot of weight during it. I wouldn't necessarily say this is a great weight loss program because a lot of that weight you'll put back on once you start eating again. But it is a good way to kickstart yourself if you want to start losing some pounds. This gives you a little nudge. Um, but I do, generally feel great afterwards. While I'm doing it, I feel pretty fine. I still do my workouts, maybe at like 75% intensity, but it's not like I'm, without energy and just lying on the couch, for 5 days. So it's a very manageable process. Honestly, Lance, I'll tell you the hardest thing about it is I tell you they give you, a little bit of food every day. By far, the most calories they give you are these packets of green olives. And I hate olives, and now I know how much I hate olives because you want to eat all the food that they give you, right? And oh, okay, today's big thing is olives, right? No matter how hungry I get, I still can't choke those things down. So
I like olives, so that would be okay with me. So
yeah,
that's
so if you like olives, this thing's for you. And sadly, they don't have like an olive replacement. They say, yeah, if you don't like the olives, sorry, just maybe pour a little olive oil in your soup, but other than that, don't supplement with anything else. So that's the toughest thing about the thing for me.
olives, or do you just skip them?
But pardon me?
You choke down the olives, or you
Oh
skip them?
no, no, I skip them. I mean, and look, I eat just about everything on this planet, which goes to tell you how much I hate olives.
That's
That even when I'm, basically starving myself, I still can't choke those things down. So anyways, this system is called Prolon. And if you want to learn about it, you can go to thoughtfulmoney.com/fast, which will take you to Prolon. They'll tell you all about the science and everything behind this. But that link I just gave you will give you the opportunity to get 25% off of Prolon's fasting program if you decide that's something that you want to do. So hopefully everybody, I answered all the questions that you had around the fasting. If I didn't, ask them in the comments section and I'll try to respond to them. But Lance, have you done anything like this in your training?
yeah. No, fasting was when I was training hard. In particular, fasting was a regular thing, but I still fast.
Did you have to make weight? Is that part of why you did it?
Oh yeah,
Yeah.
yeah, sure. But yeah, there was always that week before where it's the garbage bag on a bike or a treadmill,
Yeah.
food, no water, right?
Yeah.
Trying to
And
make
garbage bag, just for folks that don't know, it's because you'd work out with that on and it was designed to get you to sweat a lot, right?
yeah, no, yeah. We just used to when they'd untie the bottom of the garbage bag, be like a gallon of water would come out.
Yeah. Gross.
But yeah, but no, even now, I fast on a pretty regular basis. I don't. I literally don't eat. I don't eat every day until about 11 a.m. I don't eat breakfast. I eat at 11. I have dinner around 5, and I don't eat again until the next day at 11. So I'm fasting between 12 and 16 hours every day. So, but I
So
do
you're
that
doing
on
sort of the intermittent fasting on a daily
yeah,
basis.
that's and it's just really it's a function of habit now more than anything
Yeah.
else. The way I'm kind of wired. But then yeah, about once or twice a year, I'll do a 3 or 4 or 5 day fast.
All right. Okay. Well, look, folks, if you think that if you find that the best investment you can make to your health, both physical and mental, is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Lance, can you remind people about the date of RIA's upcoming conference?
Yep. And by the way, you need to let me know what days you're coming because I have to reserve your room for you. So because
Okay.
the hotel's booking up.
I'll do that right after here, but I'll be there for the whole thing. So
All
I'll
right.
be there the Friday night before.
But yeah, so it's January the 17th. is the actual conference. If you go to our website, realinvestmentadvice.com, we have a link right at the top of the page that will take you to the registering page for that. And again, so we have kind of two things going on. So the actual day of the conference is January 17th. It's a Saturday, but the night before, Friday, we're going to have a dinner. And so we've got another ticket that you can come and just, it's going to be heavy hors d'oeuvres, kind of a mix and mingle environment. All the speakers will be there: Adam, myself, Daniel Kang, Brian Dunlap from BlackRock, Ed Slott, who will also be there as well. We'll all be there, kind of hang out, mix, mingle, talk, visit about whatever you want to visit about. Then we'll have the conference the next day. But yeah, if you go to the website, realinvestmentadvice.com, just click on the link at the top, says register now. We've already sold about half the tickets, so they are selling out pretty quickly. So I encourage you, if you're going to come, let us know and we can help you. We have a block of room set aside, so we can help. If you'll email us, I can get you in touch with Michelle at my office. She can help you arrange your room. But yeah, tickets are selling pretty quick. So if you want to come, we'd love to have you. But I would get kind of moving on it now.
Okay, great. And you probably already said this, but this is in downtown Houston, right?
Right. Yeah. So this is a live event in Houston, and very limited seating. We've only got about 120, 130 seats altogether. So
Okay, and there's no like live stream to this. So if you want to participate, you got to be there in person, right?
yeah, this will not be streamed, recorded, or broadcast afterward, due to basically we have NDAs with a couple of the speakers.
Yeah.
So
Well, and that's one of the great things about these live conferences is not only getting to spend time with a lot of like-minded people and great experts, but oftentimes, we have conversations that are at a depth that sometimes can't be had on camera because a lot of the participants are prevented from talking publicly about some of the stuff. Yeah. All right, folks. Well, look, if you would like to get some help from a professional financial advisor, perhaps even Lance himself and the team there at IAA for managing your wealth through next year, which if I took good notes, Lance says could have some big unexpected events in it, while at the same time we're entering it with a very fragile market. So if you'd like to get some help from one of those advisors, or one of the advisors that Thoughtful Money endorses, the firms you see with me on this channel every week, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you right after you fill out that form to have a conversation with you. Also, too, just want to remind people of the special offer that Andy Schechtman and his firm, Miles Franklin, are offering to Thoughtful Money followers right now, which is the ability to buy junk silver at $1 below spot price. So if you haven't taken advantage of that offer yet, but would like to, just go to thoughtfulmoney.com/buy gold, fill out the very short form there, and you'll be connected with Andy and his team to fulfill that for you. All right, Lance, as usual, it's been another great week. Have a lot of fun with your daughter tonight and this weekend. I'm looking forward so much to doing the same thing with mine in just a couple hours.
absolutely. Thank y'all. See y'all next week.
All right. Everybody else, thanks so much for watching.
Silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth.
With $44 as the next objective, silver is currently in a great setup for a breakout. It may reach as high as $49.50 an ounce in a traditional parabolic. The story is being driven by breakthrough technicals, tightening supply, and industrial demand. According to Investing Haven's forecasts, silver will first challenge all-time highs, reaching about $49 in 2025. Money is shifting right now. Investors are pursuing silver and gold miners who have been rising in value, and gold has just rebounded, so they are taking profits there. In order to prepare for the next step higher, miners may now pause as profits are taken. This money might then turn back into gold. Chris Vermeulen is a market strategist and technical analyst. He points out that silver is in a good position. According to a recent commodity forecast, bulls are aiming for $44 if resistance is broken, and silver is now trading close to $42. Although silver is more speculative than gold, both are expected to continue to rise as a result of this rotation. Silver is breaking out, according to technical breakout assessments, both in terms of its absolute price and in relation to stocks from 4-year bases. In certain technical models, medium-term targets of $49 to $50 are repeated. At the same time, gold's consistent increase serves as a warning to markets about anxiety around the world. While IT giants continue to drive U.S. stocks to near-high levels, internal weakness and exuberant sentiment point to the possibility of a significant correction in the near future. There are fissures in well-known industries, momentum and investor confidence are brittle, and valuations are high. Analysts warn that some profit-taking and sideways moves are typical following strong runs, in miners or metals. Although resistance has been breached by silver, further upside is contingent upon maintaining volumes and avoiding reversals. Chris believes when the cycle changes, investors need a strategy to identify trend reversals and safeguard their money. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish, and industrial stocks are rocketing higher. Businesses think things are good. CEOs and factory workers or management are upgrading their facilities, thinking, this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end. And when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on it's like a beehive mentality. The whole world is nervous that something is about to happen. And they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system. And gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall, and trends are going to change. The economy situation is going to change, but gold has just been on this tear, and it's outperforming and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to like the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here. I think it's kind of camouflaged with, Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems.
Mm-hmm.
Now he's the wealthiest man in the world and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end, and to have a game plan to at least avoid a crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart, really over the past week, the stock market has gone from this lime green, this oversold market condition where it's sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold, is usually when value hunters step in, bargain hunters or institutions, and they buy it back up, and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. Everybody seemed to be piling into the market yesterday. They don't care what price they pay. They're using market orders, which means they're buying at market, and they don't care what price they pay. When there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in and they believe the market's going higher and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really, it's kind of, as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market.
Chris Vermeulen emphasizes that gold has had a strong run recently, and is now pausing in a sideways bull flag, which often signals it's ready for another breakout soon. While money has rotated into silver and gold miners, those positions may see profit taking, with flows cycling back into gold. Chris prefers gold, whether physical or through ETFs. They warn that if equities drop sharply into a bear market, even gold could face temporary selling pressure from panic and margin calls, but it usually recovers faster than stocks. Current conditions resemble 2007, where gold continued to rally even as equities topped, suggesting more upside before any broader correction. Let's dive into the interview.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways. And it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. and we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. And, I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold. And gold has got this little pause that it's just had. And now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. The problem is we're coming to a turning point. And when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up. And eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Short term, typically we see gold, like we could see the stock market top out and potentially fall 10, 15% from here. And gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily, but it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally in this particular situation. 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point.
It is more crucial than ever to have a clear plan in place to safeguard profits and handle reversals as global uncertainty increases and stocks reveal underlying fractures. How likely is it that silver will maintain its pace toward $50 without seeing a dramatic reversal if it breaks over $44? In the event that U.S. stocks undergo a more severe decline, may gold and bonds serve as the most secure hedge? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I think everything's on the table. We just have to be patient. We have to be appreciative of these prices below $40. I think once it takes out $50, it can happen rather quickly that we rally towards $75 and then maybe $100. And technically speaking, we have the mother of all cup and handle patterns in the silver market. It's a 50-year pattern there in the making. And on a linear chart, we're talking $100 price target. On a logarithmic chart, we're talking $500, $600, $700 price targets for silver. And if we look at the gold-silver ratio, you can also definitely make the case for three-digit silver. These are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years.
Silver supply is limited since little new production is coming online, and most is just a mining byproduct. The speaker believes silver is setting up for a massive move, supported by a 50-year cup and handle pattern. Once silver breaks $50, it could quickly surge towards $75 and even $100, with long-term targets as high as $500 to $700 on a logarithmic chart. The gold-to-silver ratio also points to the potential for three-digit silver prices. On gold, the outlook is similarly bullish, with projections of $4,000 to $5,000 in the near term and the possibility of $10,000 in the coming years, with a shallow pullback to $3,120 presenting a buying opportunity. Demand remains strong in Asia, led by China and India, where cultural and safe haven buying continues to support prices. Hong Kong gold imports surged 127% in July, while China's overall consumption dipped 3.5%, though bar and coin demand jumped 24%. Chinese investors also drove record ETF inflows of 70 tons in 1 month, doubling their share of global ETF assets to 6%. In India, jewelers stocked up ahead of festivals despite high prices, paying premiums up to $4 per oz. Overall, Asian physical demand was robust, with Chinese bar and coin purchases up 44% and Indian demand up 7%. Florian mentions that gold is holding steady amid a softening US dollar and yields. Overbought conditions signal a need for fresh catalysts to break past $3,400, though the metal remains well supported. Major institutions such as Goldman Sachs and JP Morgan forecast gold prices reaching $4,000 by mid-2026, supported by structural rallies and dollar weakness. Pullbacks remain possible if gold becomes overbought or risk sentiment improves. Before we begin, please subscribe and enable the notification bell so you stay up to date.
I mean, here we are, end of August. Everything's a little bit slower. That's totally normal. People should actually spend this time in the summer with the families at the beach or at a beautiful place, taking off and like recharging, right? So nothing to worry here. Of course, last week, the big Jackson Hole event kind of like created some volatility in the markets, but I would not overvalue all these statements. I mean, in the end of the day, it's the price action. The market usually is dictating what the Fed is in the end of the day doing. So we have seen gold consolidating now since end of April, more than 4 months. Healthy consolidation on high levels. I think you and I agree that we probably both have expected maybe a bit more of a deeper correction back in end of April when it rushed to that new all-time high at 3,500. But all the market gave us was a low at 3,120. And already that looks like a buying opportunity in hindsight because gold is trading nearly 10% higher. So it's holding up really well. I think it's strongly supported by the physical demand out of China and Asia, of course. But I think also slowly but surely the Western big money, so to speak, is waking up to the fact that gold is the last man standing. And it's a clear bull market in comparison to all the other markets. You have a very strong, clear bull market in gold. And I assume that it's just a question of time until we see the next leg up. Gold is trading in a tight trading range. It's getting tighter and tighter. Over the last few weeks, it's been less than $100. We had some days recently with less than $10, $15 of a trading range. And it doesn't take much for gold to break out. I mean, already 3,400 is already the next probably buying signal here, pro-cyclical buying signal, if it breaks above that, and it just takes another $5 from you as we speak. So it looks very bullish. It's been holding up very well. It's, I think, the most interesting and exciting market. It reflects not only the things that we just talked about, historically speaking, and when it comes to value investing, etc. But of course, it's also a geopolitical, in-depth kind of story that you can read if you look at the gold price and its development. So I think it's all looking very, very positive and promising for gold here. Usually these consolidation periods end with one little bear trap. You get one little quick nasty sell-off that shakes off all the weak hands, and then the market turns around violently and rallies hard to the upside. Maybe that's still around the corner in September, but I don't see any big downside here. I think I wrote this in Gold We Trust report in May already. I said gold is most likely not coming below $3,000 anymore, and here we are. And it's holding up very well. The only situation where I could see a little bit more of a challenging times ahead is really if the stock market would get into a deeper correction, something maybe that like we've seen in January until March, with big final panic kind of in the last days of March, early April. But whenever this liquidity suddenly disappears, and then of course gold and silver prices are also affected in the short term, but whenever this disappears, the liquidity, magically a few days later it reappears and shows up again, and then it's a buying spree within a 2-week kind of, everything changes, and 2 months later you have new all-time highs in the stock market. And of course gold and silver is also strongly moving higher. So remember that sell-off that quickly led to silver falling below $30 actually was the launching pad for that 40% rally since then in silver. So it's always this mass psychological phenomenon. It's sometimes hard to time, but usually you can see in the charts more or less what's around the corner. And here we are. It looks like gold is about to break out and move higher, and it doesn't take much to the all-time high. And after that, I think we're moving to $4,000 rather quickly.
Florian points out that we are clearly in a precious metals bull market, but it hasn't reached the euphoric stage yet. Other assets like Bitcoin, tech stocks, and real estate have captured attention, while inflation and economic strain have limited many investors' capacity. Still, with ongoing money printing and global instability, gold and silver are likely headed much higher. Typically, bull markets end with explosive moves where prices double in a short time, and we haven't seen that yet. Looking ahead, continued fiat currency debasement could drive gold toward $4,000, $5,000. Rising volatility is expected, with daily price swings of several $100s possible, similar to past hyperinflationary episodes. The main concern, however, is the push for central bank digital currencies and tighter financial surveillance, which could make it harder to trade precious metals openly and potentially push transactions into black markets. Let's recall the interview now.
Well, I think we are in the bull market, right? So the surprise is clearly to the upside. Usually those bull markets end in total euphoria. I don't think we are there yet at all. I mean, you don't have your taxi driver and your grandma telling you all the day to buy gold and silver.
Your grandfather did.
So
though.
I think, yeah, but my grandfather, mom has not called me telling me
All right,
to
right
buy
on.
gold and silver. He just bought. I mean, it's another one for like usually the joy come kind of late guys. I don't see them moving into gold like euphorically right now. I think there's so much going on in the world of investments and so many other topics. Of course, Bitcoin has taken away a lot from the gold cake over the last 10, 15 years, and the tech stocks. And also, I think many people just don't have as much money anymore because inflation and all these difficulties during the COVID period. It's a complex kind of setup that we have here, but we are in a bull market in precious metals. I think the best is yet to come. Usually at the end of such a bull market, you see that asset doubling within a few days or weeks. That's usually the signal where, oh, now it's really the top. We want to be careful and probably move into something else, but we haven't seen anything like that. I think that the Western world is in such a dire shape that money printing will prevail and even intensify over the 12 to 24 months. And that will push every asset overall higher. So I've been calling this the cracker boom for many years already. And I also described it before a little bit, like you have, in the end of the day, the depreciation of your fiat money is making sure that most of the good assets, or more or less good assets, are rising over time. So your real estate is becoming more dollar in euro. Your stocks, the good stocks at least, or the better ones, or the ones that are being chased through the village right now, are moving higher. And of course, precious metals and Bitcoin as well move higher overall. I think we're going to see a lot of volatility. I think that, and that's, by the way, if you the Weimar Republic hyperinflation, you can see how dramatically the volatility increased in the years between 1921 and 1923. So something like this is very likely, and we probably will then also see $300, $400, $500 swings in the gold price on a daily basis. But we're not there yet. That's why we should appreciate these rather quiet times right now. I think gold is probably on the way to 4,000 and then 5,000. I mean, these are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years. simply because I assume that the money printing, the fiat money printing will continue. And in the digital central bank kind of money that they try to push on us, that's my main worry, actually. And it's very hard what to make out of it, to be honest, because it can theoretically mean that at some point we're not able to buy and sell our precious metals within these currencies anymore, and we have to maybe go back to black market kind of situation. Who knows?
Florian emphasizes that gold and silver are firmly in a long-term bull market, supported by strong Asian demand, central bank buying, and technical setups pointing to much higher prices. While both metals may face short-term volatility, their role as safe haven assets amid fiat debasement, economic strain, and geopolitical uncertainty suggests far greater upside ahead. With projections of $4,000 to $5,000 gold and silver breaking toward triple digits, the next explosive phase of the bull cycle may be closer than many expect. Could central bank digital currencies limit access to physical gold and silver, reshaping how investors participate in the bull market? What technical or fundamental signals would confirm that gold and silver have entered their euphoric, final stage of the cycle? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up, and remember to subscribe for future videos. Thank you for joining us on this adventure.
I think gold is going much, much higher. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And as I just said, $35,000 per ounce, I mean, that's the highest numbers we have heard on gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122.
You can't get rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seeberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Seeberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Seeberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate. And because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the US point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40, 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly, for
But
those...
hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to... What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing, and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately...
That will absolutely unload everything into wherever the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I
don't think it tops yet. I think it has a little more higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not. It will be about. Trader? Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was. It was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
that's retail.
Leveraged.
That's not central.
No. But
this is good. This is
exactly.
good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the central bankers
sovereign state. It can also be sovereign nations that can be a problem. It can get a problem if you start to see that they're, the yield levels are spiking up.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there'll be a plethora of things. I think it'll be driven about the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold. And the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what happened in 2008. I'm just trying to find.
Arguably, which is the 35% decline.
Unlike 2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike
discussing.
2008 though. Today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08?
Henrik suggests gold isn't in a bubble, but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now, let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the US dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that.
Mm-hmm.
And we also know that normally when we have a real gold bull market, we'll see silver follow.
Mm-hmm.
Silver is not at all-time highs yet. And there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to see
point.
a decline.
I also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it just doesn't make sense. It doesn't make sense. It doesn't make sense that, but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here because everybody's been talking about inflation and how debt is a problem, and that is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the DIX is going to, when we go through this whole shit.
There's an industrial component to silver, number one. And
that's my perspective.
I get your perspective, Henrik.
That's my perspective.
And hyperstagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very low.
A number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. Gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? You still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No. I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, guys, I know the saying of institutional adaptation and all these things, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt?
Yeah,
This
but
is the
again,
gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000, the
no,
1980s
I'm not.
high.
I'm not.
This
First
is
of all, I'm not.
adjusted for the fake statistics that you like, the BLS. These are their stats, dividing by the CPI, and that's where you are. You haven't even met the CPI adjusted high of 1980, and we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.